This interview is disseminated on behalf of Summit Royalties. My name is John Feneck, and this is the Feneck Commodities Report on investorTV with my YouTube partner, Don Durrett, founder of goldstockdata.com. And with us today is Drew Clark from Summit Royalties. Gentlemen, how are you?
Nice to be here.
Yeah, nice to meet you, Drew. Thanks for coming on.
Pleasure.
Yeah, so we're excited to hear from you, Drew. We believe in the royalty model. We don't interview too many royalty companies these days because royalties. I think some investors think that royalties are more of a safe bet in the gold and silver space, but there's a lot of value there because it de-risks a lot of the opportunity. And you're seeing that volatility play out here over the last 6 sessions that we've been at war with Iran. So would you be kind enough to give us a 10-minute overview of Summit, and then we'll ask some questions?
Yeah, that sounds great. I'm going to share my screen here quickly so you guys can follow along. I'll give a quick overview. I'm going to make forward-looking statements, of course. I'm going to do everything in US dollars today just to make life easier for everyone. So at a high level, we started this company. We've been trading for less than 4 months. A year ago right now, just to phrase sort of the cadence that we built this company with, a year ago right now, we had $5,000 in the bank and absolutely no assets. Today, we are publicly traded cash flowing business with 46 royalties and 1 stream under contract. The team is exceptional. It's led by myself and Connor and an incredible board. Everyone has built $1 billion company. And for context here, our market cap is currently around $75 million. The business is built around a cornerstone of cash flowing assets. We are making more money than we spend every day right now, which is something I'm very proud of for a nascent sort of royalty. And we're going to talk about the upside in some of those projects a little bit later on, but it is right now there is no going concern. It is a real business that's generating revenue. It's growing every single day on the back of some of the initiatives. And this is all based on publicly disclosed mine plans and reserves. The capital structure is airtight. I know this is something that you guys like to focus on, and I do too as an investor. We have issued absolutely no warrants in the history of this company. Everyone has had free trading stock from day one. And more importantly, management owns 15% of the stock, which shows very good alignment. The stock is simply the cheapest on a price to NAV and revenue basis today. That's a factor of the fact that we are relatively unknown. We're multiple initiatives underway to sort of unlock that value. We've got research coverage coming out soon from a couple of investment banks here in Toronto. We've got the OTC listing. We need to get out on the marketing, and that's why we're happy to be engaging in groups like you. The demonstrated execution for accretive growth is something I think that separates us. Between myself and my other, my right-hand man, Connor, you've got 2 guys that are full-time employees. We believe in keeping the G&A tight, and we've done almost $2 billion worth of acquisitions in the last decade between the two of us. So let's just quickly jump into the capital structure here. And some of this will be, explained a little later on as to why, IAMGOLD is a large shareholder. Today, we're about a $75 million market cap. We've got $3 million in cash and a silver receivable. I'm sure we'll unpack a little bit later on, and absolutely no debt on the balance sheet. We raised all of our money at 90 cents Canadian from a list of well-known institutional investors. I'll name a couple of them quickly here: Adrian Day, Delbrook, US Global, Libra, and Macquarie, and a small fund called Spartan here in Toronto. We do have other funds in the book, but not ones that we can disclose. We did this with absolutely no warrants. Everyone had free trading paper right away. So it's a very clean capital structure. There was an RTO done. There are some warrants in the structure. They expire in May. They're at $2.50 Canadian, but those aren't ones that we've issued. There's nothing capping the stock from running to $2 or higher on the back of all of this. Team's important, and I'll talk about myself first. I've been on the street now for 20 years. 10 years of it, I was as a sell-side analyst / investment banker. I found myself on the issuer side where, I've had a lot more fun, and it sort of speaks to my entrepreneurial side of things. I got the royalty bug at a company called Premier Royalty. We took that public, and it was acquired by Sandstorm. I also went with part of that management to a group called Carlisle Goldfields, also acquired as well by Alamos. But more relevant to what gives me the currency to run a company today as a first-time CEO, I was the first employee hired at a company called Metalla. The royalty count there was sort of in the 17 to 20 range. We took that over 100. We took it from a $30 to $40 million Canadian business to over $1 billion today. Flanking me on the screen here is Connor. Connor has 4 years of investment banking in Toronto and 4 years of Triple Flag. He's done, $500 million streams. He's acquired multiple mining royalty companies as well. And we make up, the only 2 full-time employees of the company. The board's important, and we touched on Gerald a little bit earlier, but all of these guys on the screen have been part of building billion-dollar businesses. We'll start with Gerald. Gerald was 10 years of mining sales at Scotia. He took his talents to work for Richard Wark. He sold Arizona Mining for $2 billion in cash. He then went to Capstone Mining. That stock went from 60 cents to $10 under his purview. He's done billions of dollars of secondaries, listing, and M&A while he was in that seat. Not to be outdone, Russ Mills is a well-known investment banker here in Toronto. He now works at an independent one called MDCP. Recent deal that he's done, he helped Foran got acquired by Eldorado. He's done hundreds of millions of dollars of royalty M&A. Steve Eddy comes with IM Gold. He's done billions of dollars of M&A. Very important for us in terms of his Rolodex with the majors, and was we were lucky to add him to the company. And then Blair Zaritsky is actually the first person I approached to join the board. He's the CFO of Osisko Metals, formerly of Osisko Mining. He's done more complicated deals than I ever want to endeavor to do. But what you've got here is a team of guys that have all written in checks at 90 cents that are all heavily motivated to grow this business. So how do we build this company? And we'll talk about the assets in a little more detail, but I think it's important because it kind of shows you how we've gone where we are. In May of last year, we closed a $13 million financing, again at 90 cents with to fund the IM Gold deal. On the back of that, we closed an acquisition where we brought in 7 royalties in one stream and brought them in as a major shareholder. So we gave them $10 million in cash and 7.5 in stock. 1 month after that, we did an RTO with a company called Eagle Royalties. That's where we get a bulk of our royalty count, and more importantly, a royalty on Banyan, which I think has tremendous upside in the stock today. It also came with $3 million in cash and securities and 3,000 retail investors. And when we talk about starting royalty companies from scratch, having that liquidity early on is important, and it's something we're still focused on. While doing that RTO, we did our third bilateral deal with Sprott guys to buy their royalty on West Red Lake's Madsen mine. We bought that for $8 million up front with a contingent payment for $2 million. And the reason this was important for us, and now metal prices have cooperated, was we were coming out with a portfolio that was, revenue break even or cash flow break even. Bringing in Madsen, not only was it objectively a good deal, and I think it's worth multiples that we paid for it, it made us cash flow positive out of the gate. And I think that was one of the key things when we started this company as to what was important to us when we started. What's amazing about this, though, is, and talk about timing, I'd rather be lucky than smart. Hopefully I'm a bit of both. When we signed the IM Gold LOI in November of 2024, gold was at 2,600 and silver is at $30. So we couldn't have timed it much better. Mm-hmm. From a valuation perspective, now this is a bit of a dated slide, but we're kind of in the 0.8 times NAV range. Now our NAV is underwritten by publicly disclosed mine plans, the economic interest under contract, and consensus gold or silver prices. We have added no upside to any of our numbers. And one of the reasons we did that is we wanted to show people what is a very defensible value proposition today. We do not have some of the friendlier valuation approaches that you get from some of the sell side community. We will have research coming out soon, and we look forward to being able to show these are not our numbers, these are other people's numbers, but we think the value proposition is fantastic. Again, this is a consensus gold prices and silver prices. I'm going to skip this slide just in the essence of time. So let's talk about what makes up the portfolio today. And more importantly, I argue very comfortably that these 4 assets underwrite the entire market cap of the company today if you run a 5% discount rate and the mine plan that's under tow. So Madsen is a high-grade underground gold mine in Ontario. They're guiding for 50,000 ounces a year right now. There's upside with the drill bit. There's upside at the plant. And the one thing that I love as a royalty guy that I don't think we do enough is there's sort of 3 levers we can pull on to generate accretion. The first one is gold or silver prices. Rising tide lifts all boats. Your NAV could come up. The second one is resource expansion. In most cases, absent a high-grade discovery, it prolongs that payment. And look, getting paid for longer is nothing wrong with that. But all of these assets, and I touched on this with Madsen earlier, have throughput expansion opportunities, some actively being done as we speak. When throughput is expanded, it's recognized on your income statement the next quarter, and it's recognized in your share price right away. And because we bought assets that are in the first or second inning, we have throughput expansion on all these assets that are not recognized in the valuation proposition I put in front of you. Madsen is running at 650 tons per day right now. The mill is rated for 1,100 tons per day. There's 2 million ounces of gold there. So if you run 50,000 ounces at 2 million ounces, you'll get a 40-year mine life. The propensity for them to want to grow that plant is very obvious to me, at least. Bombore is a very special silver stream that we have. And there's a couple of reasons why. One, we love the passive silver revenue that's very hard to find in the market. They're taking their mine from 120,000 ounces in 2025 to a run rate of about 250,000 ounces by the end of 2027. One is actively just been constructed. They've done a hard rock expansion. So this year we're going to see a 50% increase in gold, 50% increase in metal because the silver comes with it. And then next year they're going to double it again. We pay no cost whatsoever, and there's no taxes on that silver whatsoever. But what's really exciting about that, and I didn't touch on it earlier, there's a 37,500 ounce minimum payment they have to make to us. In the early years, they didn't meet those. So they actually owe us roughly 75,000 ounces that will be payable at the end of next year, early 2028 at the latest. So we've got a tripling of the silver price, a doubling of the gold output, and then we've got this receivable that, as long as silver continues to cooperate, is actually appreciating. So it's a really fantastic asset, and the company itself is terrific. It's about a $2 billion company. They've built everything on time and on budget. So we're really excited about to see how that kind of unwinds. Bombore came from IAMGOLD as a reference, and so did Pitangui and Zancudo. But let's talk about Pitangui. Pitangui is a satellite deposit that's about 20 kilometers away from the Turmalina mill. Jaguar runs it. It's about a $700 million company. They've been operating there for 20 years. It's starting development this year and production next year. And the revenue out of the gate on this thing is fantastic. We get $80 an ounce for the first 250,000 ounces. Then it drops to 1.5% thereafter. It's aiming for anywhere between 30 and 50,000 ounces, but at $80 an ounce, you're looking at $3 to $4 million of revenue. And this is all, if you go to their website, you can see starting in 2026, production in 2027. Zancudo is sort of the smallest of the four here that we're going to talk about, but I think it's the most exciting based on where it's going right now. So right now it's a small direct shipping ore operation. It's actually making money despite being sort of a smaller operation. And that's a testament to the grade of that asset. The team building that, this is Denarius Metals, built the Segovia mine for Aris. It's the largest gold mine in Colombia. They're installing a 1,000 ton per day mill that'll start ramping up sometime in August, September. I believe it's Q3 is their guidance, but there's an unbelievable amount of exploration upside there. And I think there's propensity to expand that mill with time. Once again, taking a step back, all four of these assets come for free in our portfolio. The most exciting asset in our portfolio, and probably I'm only really going to talk about five today because we're doing a quick overview, is the AurMac deposit. AurMac is run by Banyan. It's about a $500 million company. It's had exceptional drill results as of late on the drill on the drill program. We have a 2% in the north and a 1% on the western extension in the south. I don't know if you guys can see that. But where it gets exciting, and this is directly from their website, is this is the high grade hits they've been hitting. As you can see, it lines up very well with our royalty ground. Here's where their indicated ounces are. But as a reference, this resource is kind of in the 0.6, 0.7 gram range. They have found this high grade structure that goes from airstrip to power line where they're hitting 60 meters at 9, 40 meters at 4. I think this has a significant economic impact on the future of this ore body. On the back of their exploration success and getting 100% ownership, the stock has gone from 20 cents to $1.40. We're really excited to see where this goes. But what's really exciting about this, and I can't stress this enough, I think this comes for free in our portfolio. They're putting out a new mineral resource estimate this quarter, and then that'll be followed up by a PEA. That PEA is guiding towards over 300,000 ounces a year. This has potential to really, really drive massive gold equivalent ounce growth in our portfolio. And this could arguably be our most valuable royalty today. Why that's exciting though, and I'm going to talk about this slide here in a second, is we think this has the potential in sometime in the early 2030s, or at least get recognition to potentially double our revenue profile. What we have here today on this slide though, is what we know right now. There's no arm waving. There's no subjective start dates. These are publicly disclosed start dates. We have a business that will generate well over 10 million bucks a year, starting in 2028, much more than that if you use today's spot prices, for a long, long time. On a revenue basis, it's very enticing, but this is very much so a defensible, reserve-driven, mine plan-driven gold equivalent ounce profile that we're very proud about, and this is our starting point. When we take a step back though and look at the portfolio itself, there's 47 in the portfolio. I'm just going to focus right now on the net asset value stage. 45% of our portfolio is in production right now. 12% has a committed timeline of production. That's Pitangui. 43% is made up, and that's dominated by Banyan. We have unbelievable call options within that portfolio. We have a royalty on parts of Skeena. We have the extensions in Mount Poly. We've got a resource extension in the San Gabriel mine that Buenaventura just put into production. But what I love about this, because we're trading at such a discount, I don't have to argue for value and the optionality right now, but we have it in spades in the portfolio. What's going to change this year, and I'm just about to wrap up, I promise, is we are going to get research coverage. We're going to start marketing more heavily. We have been trading for less than 4 months. We are totally unknown in the space, but the portfolio itself is going to do a lot of heavy lifting for us. First one was actually already occurred 2 months ago. Commercial production in Madsen, but they're putting out a PFS. They're drifting into new ore bodies. They're ramping up as we speak. Things are really going to continue to go well there in our estimation, and they're going to come out with a longer mine plan. Phase 1 completion at the Hard Rock of Bomboré. That's a 45% increase in gold ounces. Again, it's about the silver comes with it. But I'd say the biggest catalyst for us this year will probably be the PEA and AurMac, because people will all of a sudden be able to sit back and see exactly what kind of economic driver our small royalty potentially has on it. And then, just the starting of work at Pittingy is going to be fantastic. It's just a check mark for us as royalty holders. And then the ramp up at Zancudo. We're getting a small amount of revenue out of that right now, but that's really going to get going. It's a very well balanced portfolio. It's a very tight capital structure, and it's a team that's been there and done that before. And where we're going to take this thing is we are going to continue to execute on our plans. We're going to do more deals. We're going to grow our market cap. We're going to grow our multiple. We're going to grow our liquidity. And these royalty companies don't stay cheap for very long, because if you do, you get taken out. And from my perspective, if I'm looking at this as a potential investor, either of those outcomes is fantastic for someone coming in right now.
Okay, great. Thank you. So is that the goal, Drew? Is it to sell this, in a couple of years, or in a hot market like this? Are you guys willing to take a buyout this early? I would say not, right?
Look, we're all large shareholders, and I'll speak to myself, because there's no corporate vision here, and the idea is to make money for everyone. The fact that we were able to start this company and fund it and get it going, and to show people a win early and that we're not entrenched, is not going to hurt my career prospects later on, or anyone else. I think we have an ability to take this well over $2 and see where we can go. If there were an M&A sort of iteration to come our way, I would like it to be a smaller player, where it's we have a $10 million business, they have a $10 million business, and we can grow together. We get that multiple re-rate. I wouldn't want to sell to a Wheaton or a Franco. But that being said, I mean, everything has a price on it. So we're open for business. That's for sure.
Okay. And yeah, I'll point out to people, Franco FNV and Wheaton WPM were both coming out with earnings March 10th and 11th this week. So I would take a look at that. They're both huge holdings in GDX. I don't think they're going to disappoint. So I like everything you've said. I just had one question about Burkina Faso, because I've heard very mixed things about this as a jurisdiction from very smart people over the years. What's your take on that? What's the downside risk there?
Well, the short answer is it's not Nevada, it's not Quebec, but we have security. We're below the senior debt there, but it's important to bring up the senior debt. The senior debt is owned by the largest bank in Burkina Faso. So There's some alignment there on an economic side. The chairman of that bank is also the largest shareholder of Orzone's shares on the Toronto Stock Exchange. So there's some good alignment there. But let's talk about the asset itself. It's about 80 minutes south of Ouagadougou. It's not towards the Sahel, and I understand I'm not a West Africa expert, but it's close. It's to the south. They haven't had any security issues in the past. So from our perspective, we're quite comfortable. But I'll expand on this tangent a little bit. For what we paid for the return we're expecting to generate on this thing, it is objectively a very good deal. If I had to go pay, $20 million for the stream today, it would be a much different conversation. Just to sort of inform you about how we think about, building out the business in other jurisdictions.
Yeah, that's fair. Okay. The last thing I just wanted to point out, and you can add any comments if you'd like. I just took a trip to Zancudo literally a week ago in Colombia, and Julio, who is the partner with Denarius, as you pointed out, is responsible for 1,800 to 2,000 employees at Segovia, which is run by ARIS, A-R-I-S. This is like a really interesting project that Don and I like a lot. So the fact that you have an NSR there is, I think, very positive.
No, we're big fans of what they're doing, and I think, as I sort of indicated in my preamble earlier, it's small production today, but with that mill in place and the sort of the alleviation of some of the balance balance sheet stresses they had, I think they'll probably start attacking it with the drill bit a little bit more. But when the management team informed me they're making money at small production, I thought, this has got some grade. This is, it's a pretty fantastic operation.
Yeah, the grade's extremely high. It's 10 to 11 grams per ton right now, but they've been getting 15. So the ticker on that one is DNRSF in the States, DMET in Canada. We encourage people to look at Denarius. We think it's one of the better values out there in the gold and silver production category. So, Don, I'll pass it over to you.
Drew, very impressive presentation. The quality of your mines is pretty staggering, actually. I mean, every one you mentioned, I owned. Pantigi, Jaguar, Bombardier, Orezone, Banyan, Matson, West Red Lake, and Zancudo, Denarius. I own all of those. They're all really good mines. So you have some really high quality plays there. So you're currently, how many ounces equivalent are you in 2026? Are you going to mine?
So we haven't put out guidance, but let's just use, if you do 37,500 ounces of silver, which is contractually under payment, and I believe West Red Lake is suggesting they're going to do around 50,000 ounces this year. We get 1% of that. So there's about 500. So you can comfortably go well over 1,000 gold equivalent ounces.
Right. So I think on that chart you had 1.2.
Yes.
Okay. So what are your current margins? Current one, this right now as we speak, about $3,000, $3,500 an ounce.
Well, stripping out our meager G&A and some of our legal costs, our I'd say our margins are comfortably in that range. What's impressive about the royalty model as a whole, though, is as this production ramps up, we're not adding more people or doing anything. It's a very scalable business.
Right. So right now, at 1.2 at 3,500, you're generating about 4.2 million in free cash flow. I'm a free cash flow guy, so about
Me too.
around 4 million. So you're trading about a 20 multiple, which is below industry average, is what you showed. It's about 50% below, and so that's about what you're valued at. Your NAV is about 50% below, somewhere in that neighborhood. So instead of being trading 120 million, you're trading about 80. So yeah. And you have all this growth that's coming. So basically, doing the math, you're basically trading about half off, but it's even better than that because you have this growth story and you have some of these high quality properties. So you're actually trading less than 50% discount. So you actually are a really good buy here. We interviewed Vox Royalty. They have a similar model to you, where you guys, it looks like you focus more on NSRs than you do streams. Is that
so far, yes.
The strategy forward? Is that the strategy forward?
So the strategy right now is quite simple, and I agree with you in the sense that the value proposition is fantastic. But also, I would encourage people to think about the downside protections that's there. When you buy royalties at a discount that's in a diversified portfolio, you really have a good underfooting on that. But going to your earlier question about what's the strategy going forward, the idea is to grow this business accretively, full stop. Every time I transact, the NAV per share goes up, the cash flow per share goes up. Does that mean we buy streams? Does that mean we buy NSRs? Whatever we can get our hands on and negotiate an accretive deal on, we'll go forward. But yeah, streams and NSRs is our bread and butter. That's what I've done in my career, and that's kind of our mandate. Or I wouldn't say our mandate, but certainly what I think people expect from us.
Okay. I do know that we're seeing a lot of competition. I used to have around 6, 7, 8 royalty plays in my database, and now I'm up to high teens. They just keep popping up one after another. It's pretty amazing. It's getting crowded, if you will. So the growth proposition is getting more difficult. But the other thing is, it's starting to early in this. When the royalty model, I've been around since the royalty model basically started. I mean, I remember when it was like 4 companies. And so at that point, the royalty companies had a lot of leverage. They would walk in the door and say, okay, you guys, you need some money for a streaming deal. Here's what you're going to get. And my question to you is now going forward, I think the mining companies are going to have a little bit more leverage now going forward because it's easier for them now to get loans because the paybacks are like 1, 2, 3 years at the most. Most of these paybacks are 1 year, right? So I just wanted your feedback on that as far as the royalty model being a little bit more crowded, and now going forward, it's a little bit more difficult for you guys to get like really good like streaming deals. Could you talk about that?
Sure. So I'll make one observation right off the hop. And this isn't my first royalty business. It's always been competitive. This isn't new. And I think that's probably something that people focus on based on the health of the capital markets right now. And I guess originating a stream and buying one for $4.3 billion from BHP is probably not in the cards. So where we play is in the third-party royalty market for the most part. Also, some of the acquisitions that people have done recently, we look at helping guys along the way there. But the third-party market, royalties are created all the time. And let's just talk about the IAMGOLD deal. IAMGOLD sold all their royalties in 2021, actually to Triple Flag, where Connor works. In 3 years, they generated a portfolio that we transacted on a very creative basis. Royalties are created all the time through M&A. They're created all the time when prospectors sell these things. We have an extremely busy pipeline of deals ahead of us. But I think further to your question, is it competitive, and are we going to go and try and out-muscle Wheaton or Franco with our checkbook? The short answer is absolutely not. Never, a stop and don't. But we have I look at my board of directors and myself, all of us like mini corporate development guys. They're filtering deals our way all the time. And I think the one thing that I'd like to indicate here, and it's not a thesis of ours because it's been rolled out through, Metalla and Elemental and some of the other guys, but Mavericks Metals was a company that was acquired by Triple Flag, but they did one treasury offering in the beginning, and then they started approaching these large companies that have portfolios that have very good balance sheets. So go back to your point where people are cashed up and they don't have any debt. They don't need capital from us. They need to do something smart and accretive with the royalty portfolio, just like IAMGOLD deal, the IAMGOLD deal accomplished. So some of these guys are actually calling us because we have an unbelievable capital structure right now. We're objectively the cheapest one, and they get to actually, be part of that re-rate. So if someone comes in, we're trading at 0.8 and Ben's in their portfolio at 0.7, 0.8. This whole thing, especially if there's cash flow, it can trade up to 1.2, 1.3 and still be at a discount to our peers. And that's the torque that we are pursuing right now aggressively as a management team. So it was hard when I started this company privately a year ago. I mean, the market wasn't shut when we did this deal. It wasn't shut when we did the deal with Eagle, and it wasn't shut when the deal was Spot. Things are frothier now, but it's never easy. It's a very, very difficult market. It's very competitive. I think I answered your question.
Absolutely. A couple of things. One, I'm very impressed with your team, with yourself and your board and your management team. The fact that you guys have been able to, like you said, the gold and silver prices, they've only just really ripped recently. So you put all this stuff in place before this breakout. So that's impressive. You actually are showing more than 100% growth over the next 4 years. Not a lot of companies can say that. Mm-hmm. So, and you've shown that you've been able to do this in a difficult market. So going forward, I mean, this is, I'm somewhat skeptical on the growth, some of the royalty models as far as growth goes, because they're all very confident they're going to grow their companies. But yours is, the growth is already built into the model. Built in to your ownership, the properties you already own. It's already there. It's going to happen. So basically, if gold prices go higher, you basically have tons of leverage. You have leverage on the higher price. You have leverage on the growth, and you have the leverage on undervaluation. So you kind of have the trifecta there in the royalty model. So it's impressive. I remember when Triple Flag started, I really liked Triple Flag when they first came out the gate. You guys remind me a lot of Triple Flag. It's interesting because the one guy you work with, your partners from Triple Flag, it's like you guys are somewhat, you know how to get this model to work. So that's impressive.
Mm-hmm. I take that as a compliment, sincerely. And I think the one thing that I typically like to highlight in these things is people are looking for the torque and gold and silver prices. Markets are open. all of our counterparties have raised over 300 million Canadian since we started the business. That means more rigs, equipment, better balance sheets to execute on their growth initiatives. So we're pushing the growth initiative, but so are our counterparties. We mentioned Banyan, we mentioned West Red Lake. A lot of these guys have raised meaningful amount of capital and are in a better position to grow the business today. So it's the stuff that we don't know about yet that's happening within the portfolio. That's the beauty of the royalty model. So we're getting a lot of these guys are pushing, just like us.
Yeah, one final thing, and I'll be done. I just want to mention that I actually think that the royalty model works the best in the NSRs, because the NSRs are solid. They're not, when you have a deal on an NSR for life of the mine, it's solid as a rock, right? It's not. Yeah. It's a lot different than a stream, where a stream is. It can become a little bit fragile over time as the price of gold and silver go to the moon. If silver goes to $200, $250, those streaming deals get really wonky.
They do.
But the NSRs are solid.
Particularly, and look, every contract is different, and we have like very solid contracts. When you're looking at streaming a primary or even like a very important secondary metal, I would agree. Some of those silver streaming and royalty agreements that we've seen in the space, though, it's a primary copper mine and it's the third or fourth metal. I think those are in better shape, but I would certainly agree with you that streams can be punitive. But I use an example from a recent deal that Triple Flag did, and we can talk about other royalty companies. They made a high-grade gold discovery at the Evolution did in Australia, and they renegotiated the deal within the confines of it. So there is precedent for when there's a punitive stream in place and a discovery is made in that metal to play ball, because do you want to own 100% of nothing or 10% of something, right? And I'm just making up round numbers, but I think the economic drivers, there's a win-win situation for everyone in that respect, for sure.
I said I was done, but I have a follow-up for that. Your company and Vox are actually insulated from that. So if people are, own your companies, your company will not get dinged, if you will, if we start seeing some of these contracts get renegotiated.
I would agree. And I would add the one thing that it's starting to rear its head, and I've been highlighting this with some of the institutions I talk to, is right now we're in this rising gold environment with prices are staying flat. Everyone I talk to that run these operations are talking about consumables, equipment, and people. And now we've got energy spiking. And I don't know, I'm not here to suggest that the current oil spike is there for a while. But in the past, the royalty model is something people flock to when inflation rears its head. It's passive top line revenue with absolutely no cost inflation whatsoever. And in the last run up, we saw costs kind of keep lockstep with gold. And most of the big guys I talk to are like, yeah, you know what, inflation is probably going to come. And we're going to see that in the next quarter with some of these results coming out. So this is a great place to hide if you're worried about op costs.
Right. Thanks for coming on.
Appreciate it, guys.
Thanks a lot, Drew. So Don, we've got about 30 seconds here. Why don't you give us a summary of what you think here?
I liked Vox and I like Summit. I like the NSR model. I think it's pretty darn solid, really. Collect the NSRs and collect the free cash flow. For me, I think gold and silver prices are going higher. So a company like this is just going to grow. They're undervalued right now versus their peers. They're growing. They own solid properties. If you like Vox, you got to like Summit.
Yeah, if you look at that P to NAV chart that he had in the deck, I remember when Vox was under a 1, and that was around $1.80, $1.90, and now it's over $5. So these things do have a tendency to re-rate, and that was why I asked him, like, what's your intention? Are you going to hold this, or do you want to sell it? Because if you look at Vox, they held it and it worked out great. So yeah, it was very interesting.
They're not going to sell. They just started this company. They own 15%. They're not selling.
Yeah, I agree.
Unless it's an accretive deal, like you said.
Right. Yep. Well, thanks, Don. We'll leave it there, everyone. We appreciate everything that you guys have been doing for us. We hope that you'll check out our webinar March 20th. It's the first one Don and I have done for 2 years. March 20th, 4 to 6 p.m. Pacific. Don't worry if you can't make that day in time. We're going to do a replay at the same price. It's $199 US. Incredible value for a 2-hour webinar from two guys that do this literally every single day. So we hope that you'll check that out, and we appreciate all your support. Thanks, everyone.